And so today's main event, a Q&A with HUD staff. This webinar is an opportunity for NSP grantees to ask questions and solve NSP problems through discussion with Department of Housing and Urban Development headquarters staff and peers. Whether your questions deal with rules, regulations, or any other current NSP issues of interest, please let them fly. And this webinar is for all NSP grantees and their partners. With us today are the familiar voices of NSP managers from HUD headquarters in Washington, D.C., John Laswick, David Nagira, and Hunter Kurtz, and also with us today, Ryan Flannery and Jennifer Hilton. And Hunter gets double billing up there, so that's pretty good, Hunter. Way to go. Let me mute you all, and here we go. Good. So first, I know John's got some things to go over. I think it's John in terms of expenditures in your QPRs.
Yeah, thanks. This is kind of our major hot topic. I know a lot of people want to hear about closeouts, and we will discuss those briefly at the end. But Jennifer is going to talk about the importance of expenditures, and then Ryan's going to talk a little bit about how to report expenditures, because the difference between drawdowns and expenditures, and when the deadline comes, it is the expenditure number that we are going to be looking at. So, Jennifer?
Hi, everyone. We just wanted to take a minute to let everyone know that we're going to be sending out letters in the month of December to your authorizing official, which is usually the person who signed your NSP grant agreement. Basically, these letters will go out to grantees whose expenditures are not close enough to the either 100% mark for NSP 1 and 2 or 50% mark to NSP 3 to let know that we're worried you're not going to make the expenditure deadline. Mostly, this will be because some folks just need to spend their money quicker, but there are also people out there who are not reporting expenditures in their QPR. As of now, we've been pulling down numbers as a way to look to see where each grantee is at, but that's stopped now, and we're just going to be looking at those cumulative expenditure numbers in your QPR. So you make sure that you're going into your QPR. Ryan's going to show some screens and explain how to do that. But we just want to give everyone a warning that these warning letters are going to go out in December, so you'll be getting those if you're not, close enough to meet the goal. We haven't decided what the cutoff is yet, but it'll just sort of be a reminder to you and your authorizing official that, worried about those expenditure numbers, and they need updated if you haven't updated them.
Right. And there's cases where grantees are more than 100% as far as drawdowns, but they're just not reporting any or very few actual expenditures on the QPR. So it's a bookkeeping thing, but it's going to be a critical bookkeeping thing. And NSP2 grantees went through this at the 50% level, and actually the NSP2 grantees look pretty close overall. So I think it's just the NSP3 folks that haven't been through this. So I know that even some of our own staff have been a little bit frustrated about how to get this done, and so we've asked Ryan to just take us through and kind of hit a couple of points that were in a webinar about 6 weeks ago. So Ryan, are you there?
I am, yes. Can you hear me?
Yep. Thanks.
Oh, great. All right, so this is just a quick refresher on how to enter expenditures in the QPR. And fortunately, relative to the importance of entering expenditures, it's one of the easier things that you can do in the system. And Jen mentioned it's entered in the QPR, and it's in the screens. It's the first screen when you go to enter your information for a particular activity. You'll see on that first screen a financial summary, and it'll show financial data both in quarter, and that's a column to the left, and then to date, that's the far column to the right. You're seeing everything that's been entered, this particular, or everything that's taken place within this particular quarter, and then everything that's taken place to date throughout the Fields are not editable for the most part. The only fields that are editable are your total funds expended and the match contributed in this particular section. What we're focusing on today is the total funds expended, where you're entering your expenditure amounts. And you'll be entering here, or you should have been entering, to this point, would be the in-quarter amounts. So if you expended, if you registered $100,000 worth of expenditures in that particular quarter, you enter $100,000. And then DRR does the math to calculate what's been expended to date. So again, pretty simple, pretty cut and dry. We can go to the next slide. And just a point I wanted to hit on real quick, for those of you who have not entered expenditures to date or done them accurately, what we won't be doing is opening up previous QPRs for you to enter those quarterly amounts. It's not looked at favorably by the Inspector General, or IS for that matter, so we avoid it whenever possible. But it's not a function. It's not something that needs to be done. There's functionality in the system that allows you to enter basically to make up for any past underreporting or changes that need to be made for incorrect reporting in the past. What you'll do is in your current QPR, you enter the cumulative amount. For those of you who haven't entered anything, you enter the total amount that you've spent to date in the recent QPR. A key point here would be to just make sure that you enter an explanation in your narrative that says that you're bringing everything current, that this isn't only in quarter data. This accounts for everything that should have taken place throughout the past, in the past of your in the history of your grant. Going forward, you'll enter only the in-quarter amounts. So, if you are making up for $2 million worth of expenditures that should have been reported in the past, and you're entering that $2 million in this quarter, next quarter you have $100,000 worth of expenditures, you'll be entering $100,000 next quarter. DR does the math for you, and it says that you have a total recorded amount of $2,100,000. And that's it. I mean, it's pretty simple, pretty cut and dry. If anybody has any questions, I'm more than happy to answer them right now.
You've got a question on your PR expenditures, just click the raise hand button underneath the participant list, or you type them into Q&A. And I'm not seeing any at the moment.
A good sign.
So Ryan will be here if you come up with any. And shall we move on to hot topics, John?
Yeah, thanks. Well, thanks, Ryan and Jennifer. So, we don't want to alarm you about that stuff, but, we also know that it would be better if you knew the warning letter was coming to your mayor or city manager or whatever. Hopefully it's just an accounting discrepancy, but, your expenditures should almost always be higher than your drawdowns, unless you're incredibly efficient or you haven't drawn anything down lately or done much lately. So just take a look at that, and that's what we're going to be looking at in February, March when the deadline comes. So now, two other sort of follow-up things on that. One is that we will be having a webinar in January to talk more in detail about expenditures, and that is on the 15th of January, and that will look at, sort of about this and more about the accounting aspects of it. But the one, I think, important accounting aspect of it that NSP2 grantees know about is that an expenditure does not have to be, drawn for yet. It counts as an expenditure if you have received it as an invoice for work that's been performed. You may not have paid it yet yourselves, or you may not have drawn it down from us. But if you have an invoice and the invoice was received and the work was done by the deadline date, then you can count that, and you can get the numbers by having your subrecipients or other partners report to you just on that number. We will be then verifying those numbers, but it's not. There's a little bit of space there, and there will be some time for everybody to get those in straight.
To add that we're also going to be doing on January 8th a webinar looking more at the DRR and QPR side, making sure that you have your data correct. as well as a webinar on December 11th on sort of expenditures with the peer-to-peer roundtable. So you notice there's sort of a theme going on here between now and January.
Yes, and the theme is that as exciting as the closeout notice is, it's not the most important thing on your desk right now. So the first hot topic is that, we do have a closeout notice that was published on Tuesday, and hopefully it will answer a number of questions and make life easier in most respects for grantees. We're not going to talk about that today. We will, at the end of all regular questions, I will summarize the issues that are in the closeout notice, but we have a whole 2-hour webinar this coming Tuesday on the closeout notice. We will have on Thursday, the 6th, a 2-hour webinar just on demolition, disposition, land banks, and other sort of related issues, which we believe, from what we hear, are the most confusing issues for people. And I think that once you had a chance to read the closeout notice, and once you have a chance to listen to our webinar next today, you will set some of these frustrating elements, I think, have been largely taken care of. So, but we are still working on that, and we are just not prepared to take a lot of questions, or any questions, frankly, on the closeout agreement today. So I'm going to watch the participant list go from 195 to 0 here, but hopefully will keep us tuned in. So I hope you can understand that. I will go through it with you, and we are already, we have slides in development and so forth, but that we just want to make sure we have the best answers possible and the most complete presentation. Kind of go off half ready. So one other item that I wanted to mention is that we are still offering a prize for the best marketing graphics, and this is be a real prize of a $100 gift certificate to Amazon, so you can pretty much buy anything, and still SP gift, but we really want to get people to give their best shot on as if they've published flyers, any sort of graphic material that you've used to promote promote sales of the program. This isn't just what a great program it is, but how are you getting people to buy properties? Because that is the big question these days, and you're not going to be able to close out your grant until all units are occupied. So once we pass the expenditure deadline, I think that's going to be the biggest feature on people's horizons. So we are incentivizing that with a non-federal source of funds, and just hope that you can get these in. You have to submit them through the grantee web page on the NSP Resource Exchange, or you could email it directly to me by December 31st. So it's a real thing, and we really want to get good ads. I know there's some out there, so don't be shy. Okay, so that's really the major sort of hot topic that we have. I know, sort of the hot elephant in the room is the closeout notice. As I said, we'll do a brief summary of that at the end of the regular question and answer session. So just open it up for questions at this point, Ken.
Very good. Thank you, John, and Ryan and Jennifer. So I think probably almost everybody in the audience is familiar with this part. Time for your questions. So go ahead and let them fly. You can raise your hand, which is done by clicking the button underneath the participant list on your screen. You can also use the Q&A box to submit written questions. And people did not come loaded with lid for bear today yet. Okay, here we go. Now they're coming. Let's go to Dave. Dave?
Hi, our SP coordinator has a question here.
Hi, this is Nicole Jenks. How are you?
There you go.
Thank you. I have a question about the HUD pre-purchase home buyer education course certificate, because it states that it has to be done and completed prior to the buyer signing a purchase contract. But the problem that we're having is because we're a rural area, we don't really have regular classes scheduled here for that class, so we're having to set them up. And what's happening is when we have a house available, that buyer has to wait sometimes a month or 5 or 6 weeks before they can get that class. So it's kind of holding up our sales progress. Any way around that?
Well, I mean, I think that one of the issues for rural areas that don't have regular sort of location and organizations that are offering these on a regular basis is that there are provisions in the reg, as I recall, for doing this on a remote basis. So somebody, now that means they'd have to have a computer or something like that.
Webinar.
Yeah, but there's some one-on-one aspects of it. Like telephone, computer, that sort of thing. Is anything like that possible in your area, or?
Well, only online courses that are available they're charging $300.
Well, you can pay that for them. I mean, that's an eligible cost for the program. So, I think every grantee is paying for.
We're paying for the classes already for them to go live.
Right.
That's our option, is to pay for them to do the online course if they're already set to go.
Yeah. So here's the thing. I mean, you could say, we'll have them do it later, but I mean, the whole point of the counseling is to make sure that somebody's really ready. I mean, financially, they're ready from the standpoint of, maintaining and paying for, repairs and, all that stuff that people just don't always know about.
One of the big reasons why the housing counseling component was added to the program from the start was because of the foreclosure crisis that we had. And the effort here was really to try to bring in buyers that are going to maintain the homes, that are going to keep them long-term. The last thing that we want to have is a couple of years from now or sooner a bunch of early payment defaults or foreclosures because homes are sold to people that really weren't ready for it. So we will try to avoid treating the housing counseling requirement as just but really as an opportunity to make sure that these folks are ready, that they know what they're up against.
Right. Now, in some places, and again, this may not work as well in rural area, but you can pre-qualify buyers. So you basically sort of have a simultaneous process of you're developing a home in a town, and then you reach out to the neighborhood organizations or other community groups and say, we're going to have these homes available. If they're interested, they should get a credit check. They should get a pre-approved for a loan, and they can take these classes. Now, not everybody that takes the class might end up buying the house, but
and that's an eligible expense.
Right. It's if they don't, buy that house. I mean, if the person's working correctly, not everybody will end up buying a house because they'll realize, oh, geez,
I'm not ready for this.
I can't afford it right now, or whatever. Yeah. So I think those are kind of your options. I mean, I realize this stuff works better in places where there's existing agencies and sort of set schedules and so forth. But if you can get ahead of the curve by either pre-qualifying people and getting them into the program, or you're doing it on a remote basis, I think those are your best options. I mean, suppose there's probably places that have done sort of rented house temporarily, but I think that it gets hard to sort of take somebody out of a house if they end up not qualifying, through the, if the counseling sort of indicates that they're not ready for it. So I don't think I would do that myself. So maybe a great set of options, but that's, you can pay for the extra cost of doing it on a remote basis. I realize your resources are limited, but, I mean, are you using the house? I mean, if nobody's qualified to buy the house, then your closings are delayed, but you're not really losing the house. You're probably not getting as much vandalism as you might in an urban area or something like that.
And person is pre-qualified. They're pre-qualified with a lender, so they've kind of gone through some process with their lender anyways. But these are good options, so I will definitely work from. Thank you.
Okay. Well, if you still get stuck, write in or call back.
Okay.
Good luck.
Thank you. Now let's go to Chris. Hi, Chris.
Hi. This question may be more for Ryan, but let's shoot it anyway. A grantee puts NSP funds on 2 single-family houses, and because of some strategic reasons, they decided that those were not houses that they wanted to spend NSP funds on. So those the returned back grantee, actually it's sitting in a account of the subrecipient that received the funding. Now, the option, as I understand it, to send the money back to locks or to do an offset or adjustment. The challenge is they don't want to send it back to locks. In terms of the offset, changing the vouchers in DRGR, what would the amount they receive from the subrecipient? Is that considered program income at that point, or return of grant funds, and how is that inputted in DRGR? Or do they just leave money in that account and spend it on the next houses that are to be done? And the literature is not clear as to how you actually receive funds if they are not program income funds.
Right. So, just to clarify, it was simply, money that was spent on a house or on units that were being built. Weren't NSP, so they sent the money, the sub-grantee or whatever it might be, sent the money, the developer or whatever, sent the money back to the grantee, correct?
The house was actually acquired and repaired, but money was repaid. So it's the original amount that they sent back.
It's not the original amount. I mean, from a DRGR standpoint, provided they're just, they're repaying these funds, the amount that would be offset as far as offsetting vouchers, a future voucher to account for these funds that have come back would be the amount that was spent, that was drawn from DR, right, from locks. So if you want to include the additional amount, the additional amount could be shown as an other source of funds. That's done in the action plan, and then you can report on it, as a match in a QPR. That additional fund, those additional funds would be similar to just saying if the city or if the grantee decided to contribute their own funds to a project, it wouldn't really be handled in DRGR outside of saying, hey, we contributed this much. Whether they came back from another source or it was out of the general fund, I don't think from a DRGR standpoint that there's all that much in how it's treated. I mean, you'd specify what it was, but it wouldn't matter how much it was how it was treated. So generally speaking, when you offset a future draw, if you have a $10,000 repayment, let's say you have a future voucher for $10,000, as opposed to drawing those funds, you revise the original voucher or vouchers in the amount of $10,000 to whatever expense is coming up, this future voucher. So there are specific instructions on this online.
I'm okay on the side of the vouchers and how to adjust the vouchers. The side that I'm not clear on is how you record the $10,000 if not considered program income, just a receipt of repaid funds.
Well, let's say that, the total amount that you spent was $10,000, and that you drew from DRGR was $10,000, and let's say for a reason you got $12,000 back, and you repaid back to you. The $1,000 you handled at $10,000 is through that voucher revision, right? And you write in your voucher narrative sections. This is applied to this activity for this reason. You just create an audit trail for yourself. The $2,000 be handled again as an other funding source, and it wouldn't be program income. Just be another funding source that you contributed as a subsidy to that particular project. So none of this would be program income. Would all just be repay funds or the funds that have been allocated or to a different activity or a different at the local level.
Right, but are you registering the 10,000 receipted in the RGR? That's my question.
No, because you're seeding additional funds. These are funds that would have been a part of your overall grant allocation.
Oh.
These are only funds that you had paid out. You drew the money down, so you paid out. By revising those receipts, offsetting a future draw, you're basically just saying that, instead of this that we had originally drawn it on, we're going to draw it on this activity instead. We're going to apply it to this activity. So it's still there. You're not adding, available to. You're not increasing your available amount for your grant. You're saying that your funds here instead of here. Right.
So you would take the 10,000 out of the bank account and rehab the next house.
And so it would be
outside of the RGR.
Yeah, there would be no draw. That's the thing. That's the key part. Is
Right.
no draw down from locks, for you're just you're reassigning those funds, and that's what the voucher revision in effect does.
Okay. Taking that 10,000 out of Bank of America and rehabbing that next house and then adjusting the voucher in the
Right. Yes. Mm-hmm. If you need a little bit of help or guidance, there's also the one CPD AAQ. The new system that we have set up is the folks that are working this are really good, and if you do want a little bit of guidance as far as the logistics of going through that revision, they'd be able to help you out.
Right.
Okay.
So one thing before we move to the next person, just to keep in mind, is that if that original purchase of the homes never had a national objective, then the program really is supposed to be reimbursed in full for those expenses. So if you got less than you paid for them, you should probably give us a call offline and talk about that. So.
No, it's full reimbursed. It was full reimbursed.
Good.
Yeah.
Thank you, Chris. And, let's go now to Jolene. Jolene?
Hi. Can you hear me?
Yes, I can.
Okay. I just wanted to clarify the counseling requirement and what it had to be before going into contract or just before purchase.
Before closing.
Okay. Thank you.
We did also get a note from somebody. I don't know if everyone could see this screens that we see. Somebody meant that they had a $60 online housing counseling course. So, for Nicole who spoke earlier, I think maybe you want to look around and see if there's some stuff that may not be provided directly in your state but meets the HUD criteria.
Marsha submits a question about relocation, and as it relates to permanent relocation, if it has been calculated that tenants who are being permanently relocated apply for $10,000 in moving expenses, rent, etc., must $10,000 be paid in one lump sum, especially now that the grant ends soon?
Yeah, I would really recommend that you send that in to the Ask a Question, but I believe that there are some provisions that allow you to spread those payments out when it's like a rental, an income on the rent. But if it's a relatively modest amount, like $10,000, I believe you can pay those at once. And certainly for the moving expenses, that's a cost that is incurred right up front. But for those people that qualify for a rent differential payment that's calculated over a number of months, then you want to check and make sure that you can let us get an expert to answer that question for you, because I'm personally afraid of the relocation requirements. So, they're very complicated.
Indeed. Fair enough. Thank you, Marcia, for that question. Go now to Peggy. Hi, Peggy. Hi there.
So my question is whether, in thinking about sanctions for meeting the expenditure deadline, HUD planning to apply the same concerns to unspent administrative funds as to unspent programmatic funds.
Yes. There really is a distinction. It's all grant funds that have to be expended by the deadline. And so, they're all considered to be the same.
Okay. It seemed as if there was some discretion about what sanctions would be, and if a grantee coaches the grantees to sort of rush through their administrative money when they're going to have additional closeout and other requirements.
I understand the need for continued administrative funds. I'm not trying to minimize that. It's just that we don't consider those to be a separate category of funds, and so we are our intention is to recapture funds that aren't spent. I think the solution to that problem is program income, but not everybody has access to program income or has a program that generates it. So I realize that's not a universal solution, and it's if you have it, it may not be enough. So I think that realistically we would also be looking at the CDBG program or other programs like that to assist in the additional requests related to NSP.
Okay.
Thank you, Peggy. And who's next? Looks like, let's see, who's up next? Terry?
Hello.
Good. What can we help you with?
Well, the question is this. We did an internal reconciliation of our PI receipts and, of course, our drawdowns, and we discovered that one or two PI receipts had errors in them. When we corrected the errors, it now shows QPRs that the cumulative number is appearing that we've spent more than we've earned, which is not the case once we actually made the corrections. My question is, on the QPR, can we go in and actually enter a negative number to bring our numbers back in line?
Ryan's still there, but I think on QPR you change the number, can't you?
Well, so you could actually, this is something, if you could send this to me, I'd appreciate it, because we had this issue a while back and thought that our developers had fixed it. They haven't. When did these revisions take place?
This week.
Okay, so it is recent. Okay. Yeah, if you can send it to me, then that would be helpful. That way I can forward it on to them.
I can do that for you. Thank you.
Okay, sure.
Thank you.
And that goes for all you folks out there. I mean, Jim Urin and Ryan are both really great to work with and really helpful. So we don't want you feeling stuck out there. Most of the issues they've encountered before, so you should not hesitate to give them a call if you're stuck. Or
learned it all from you, John.
Send your question in to ask a question on CPD. We have, as Ryan mentioned, we have a much better crew of people working on those than we have for the last year. So that's all gotten much better.
Very good. And who's up next? It looks like a question from Leslie. Can a grantee spend 100% of their admin allocation even if they don't spend 100% of the program funds? Or are they only able to draw admin in the same percentage as the program funds that are drawn?
Those kind of things are going to be worked out. That's going to need to be worked out by the closeout. But in fact, we've seen more often that grantees are spending less than they're allowed to. Sort of hoping to hold on to some of that. But I don't think it is ever going to kind of work out exactly perfectly by the deadline. But we won't be able to close your grant, if you have spent too much money on admin and not enough on the rest of your program. But I don't think I'm positive that doesn't have to be resolved by the expenditure deadline. But if you're out of whack, you should definitely get in touch with their field office or us and try to figure it out.
It's really an accounting issue that you want to try to address on an ongoing basis, right? So as funds are being received from activity, as program income is being received from activities that you're carrying out, you want to make sure that you're staying in line with the requirements, with the 10% for program admin, and however else the other funds are allocated for other parts of your program.
Yeah, and let me mention that 10% of general, of your grant for general administrative costs does not include the cost of your activity delivery costs, which are the staff time to do the inspections and the work write-ups and the applicant interviews and all that stuff is part of your line item. So you want to take a look and see if you have been charging more to your general administrative costs than you really need to.
But to the extent that you want to charge things to activity delivery, you will need time sheets to justify the time spent on those activities.
I'd be interpreting this question a little differently, but it seems to me they may be asking if at the end of the day, if they don't reach 100% expended.
If spend 90%. I thought that they may have been asking that. If that is the question, then the answer is that come next spring, it would be February 11th for NSP2 or March, April, depending on when your line is for NSP 1 through. Be expected to spend an amount equal to 100% of your grant allocation. Not 90%, right, but 100%. So if you're concerned that you may need to admin funds after the expenditure deadline to maintain your program, that'll have to be funded out of program income that you are generating. But the expenditure deadline being 100%, not 90%, or some amount less than that. Hopefully that was everything.
Yeah, or if that's not what you're talking about, just write back or call in, let us know.
Thanks, Leslie. And one now from Deborah, who says that a subrecipient has approximately 7 units unoccupied, but is out the grant award. Can lead those remaining units to a community development corporation to sell, rent, or lease. The CC only works with people that would be considered in the 120% AMI category?
Well, yes, you could do that. I mean, you know, if all of these units are going to go to people in that income range, then you know, you might need to you need to ensure that you've got your 25% covered through some other program. But you know, each individual subcomponent of your program doesn't have to meet the 25% requirement. You just have to get it overall. You know, I think a lot of places do that. You know, they make each subrecipient make a 25% requirement on. But if you have some overspending in another category that offsets this, then you could do that.
The one thing you want to be careful with is by selling it to a CDC, it doesn't get you off the hook, right? Because you are the HUD grantee, and you're the one that's going to have to report on the national objective and the affordability period. So I'd encourage you to do, if you are looking at selling into a CDC that's going to find one of these eligible home buyers, to set up a subrecipient agreement with them and make sure that all of the rules that are that apply to you as the grantee passed on to them as a subrecipient, so that you cover yourself from a liability standpoint.
And selling the units to a CDC does not meet a national objective. It's the CD getting the units occupied.
Right. So yeah, I think David's point is a good one. You know, you don't have, you're basically having a relationship with this original subrecipient anymore. So rather than making them go, you know, set up a relationship with this new CDC, it'd be much clearer if you could establish your own relationship with them, so that they're reporting to you. You've got continuing affordability requirements to report on for the next 10, 15 years maybe. So. But it might be one where you need to get a little technical assistance. So you could, you know, Glenn, we could probably get some people to just talk through it for a few hours, or even come out in person if necessary.
With lots of people on this call today, can't be all the questions. It's not. Imagine that. So Leslie, who had just asked the question about spending down admin along with program funds, her clarification that at deadline of February or March 2013, if the grantee has not spent all of their program dollars, can they still have spent 100% of their admin?
I think no. You know, it's going to be 10% of whatever you ended up, you know, whatever your grant ended up being. So if you spent 90% of your grant and recapture 10%, then you're going to get 9% of your original grant. You're going to get 10% of the 90%. So you're not.
But it's possible that maybe it's still money in your line of credit, and other money that you've been spending has been program income. So if you add the program income with whatever you spent from your line of credit, that's what got you past 100%. You know, you can do the math a number of different ways to get to 100%. Want to make sure, to the extent possible, that you're spending on the program income out to be 10% of your allocation plus 10% of any program income that you have generated.
You know, if you're having problems meeting your expenditure deadline, please consider contacting us to get some technical assistance, and we'll help you try to hit that mark, because it's very, very important that everyone.
Right. Yeah, I can't tell from your question if this is an accounting issue that you're struggling with, or if it's an expenditure issue. But either way, let's try some help if we can. And
next, Deborah says, can a rental building leave one unit free as a, quote, swing unit? Example was if someone had bed bugs and needed to move out of one unit, the open unit would be available for that.
Not really. I mean, I think that, that maybe the situations come up, but you need to occupy all the units that you have in order to meet a national objective, and you won't be able to close out your grant until you do that. So just having a spare unit isn't really achieving the point of the program. So, generally speaking, no, you can't do that. I mean, you need to do that issue, but this isn't the way to do it.
Let's go now to Linda. Hi, Linda.
How are you doing? My name's Linda Calvert. I'm a realtor with Welcome Home Realty in Surprise, Arizona. My question is this. We have buyers that have been approved for the NSP program. The problem is that when we go to bid these homes through the HUD bid process, we can't seem to get the bids accepted because they're being overbuilt by bid by other buyers. How do we get around that?
These are FHA?
These are FHA HUD homes.
Okay.
There's no place on the HUD or digital HUD page where we can show that it's NSP.
Well, I think that the way that most cities have dealt with this problem, and almost all of them have had it in one form or another, is to go through the National Community Stabilization Trust's First Look program, and that's designed specifically for this problem of being beat to the punch or outbid or whatever. And so this is a program that a number of the major seller servicers as well as FHA are participating in. And what it does is that it gives you a short window of looking at these properties before they go to the rest of the world. So you have to move pretty quickly, to be honest with you. But if you get these updates every day, it's run off of a computer with a map on it, so you can see exactly where they are. You can see what the new listings are. Chances are at least ballpark. If it's on this street or it's in this neighborhood, it's something you're going to be interested in.
Right.
You have a couple of days to put a bid in, and that's before the clock starts on anybody else. So
that's the NSP First Look?
National Community Stabilization Trust, NCST First Look. And there is, I think, a tab on it on the Source Exchange. I know for sure it's on. It's definitely an NSP website, and really find it now.
No, if it's there, I'll find it. I'm pretty tenacious.
Yeah, and I know that's been working. I'm pretty sure that the city of Phoenix has used it extensively. So I mean, it's something that's working in your area.
Okay.
Hopefully that'll be that's a tough one because most of the banks are saying, oh yeah, well they'll this person from wherever is just going to write me a check, and so that's why we designed it, and it's been operating, and it's really pretty productive program. So, and it doesn't cost anything.
Even if it did a little bit, it's.
Well, we're paying for it. Let's put it that way.
Yeah, I'll get my people into something, Okay.
Yeah.
Thank you so much.
And Leslie, I see your hand up, but there's no phone icon next to your name. And if anybody else wants to ask a question verbally, and there's no phone icon next to your name, here's how to do it. But here we've got a couple of folks who do have phone icons. So let's go to Megan.
Hello?
Hello?
I just wanted to clarify regarding the question about the expenditure deadlines for NSP1. It's to expend 100% of the original allocation. The PI will continue to be recycled after that. Is that correct?
Yeah, the program income will continue indefinitely. I guess the point we're trying to make is that, if you've received a bunch of program income, you may only draw 90% of your actual grant through the letter of credit, but if you get that extra 10% through program income, then you're there. We look at both of those numbers together. In that case, if there's you could balance in your credit, that'll just stay there until you spend it down.
Oh, thank you.
Yeah, we'll be dealing with all this stuff a lot more on Tuesday in the closeout webinar.
Okay, thanks.
Sure.
Thanks again. And now we've got Wilma. Hello, Wilma.
So you can disregard my question was just answered.
Okay. Great. What? That's with at the moment no questions. Got any jokes to tell?
Remind everybody for your holiday buying, we have the Visual NSP merchandise store that exists in your mind only. And that's logo wear, charcoal from various demolition candidates.
We're even offering a 99% deal today, and today only.
Make an offer, yes. But really, I mean, those kind of, for that hard to satisfy person on your list, there is nothing like a complete listing of all the NSP policy alerts, or possibly a CD containing the greatest hits of the webinars, which is a very short CD, I think. So.
I just want to point out, though, that if you do get the complete policy alert listing, that only comes with the listing. You have to pay extra for the policy alerts. Right?
Well,
at 99% off, it's not too much.
Yeah, that's a great deal.
Not a big hit. All right, we do have
in the mood. I got my Christmas tie with my snowflakes on it, even though it's like 55 degrees here in your nation's capital. So we're ready for you. If there aren't any more questions, I will do a summary of the.
We do have another one. We're going to go back to Chris here again. Hi, Chris.
Hear the moans.
Are you there? Hello. Maybe.
Here. Sorry. I did send in a question, but written question. I'll ask it, and then I have another one. If you mixed-use project on the NSP one that is residential on the top floor and commercial on the ground floor, do you enter that in BRGR as two separate activities, since it would have two different national objectives and different sets of performance measures?
Yes, you would. Yes, that's kind of the only way it makes sense.
And my second question has to do with the whole matter of program income and the 25% set aside. If it is being used as a construction loan that cycles several times throughout the process, in the fund, so say it's being used to construct 4 units at any one time, so the program funds come back, and it comes back in as program income. The first go around, I would assume that 25% of the program income has to be used on units for 50% AMI buyers. So the first go around, 1 out of the 4 units, and I'm just using the numbers, is 50% AMI. So if that money recycles 4 or 5 times, you have to have, each time it comes back in, 1 of the units going towards 50% AMI, or just off at a certain point.
No, it doesn't cut off at a certain point. Every time it becomes program income, 25% of it is needs to be spent on low-income set-aside. That at the same time, if that's the only money you have, then you're constrained to that. On the other hand, it's 25% of all your funds. So,
right.
If you have other sources of funds and you're doing, 100% low-income set-aside with another fund, then it doesn't apply to every individual activity, but it does apply, and it basically will continue to be considered to be NSP money until it's all used up.
In this case, an activity is being used to meet the 25% set aside on the original grant, but once the program income starts coming back from the construction loan, I would see it as, yes, has to meet the 25% set aside. I guess the question was how many times. They're saying it's each time it comes back in another, it has to have a 25% set aside.
Program income every time. Now, we'll talk about this more on Tuesday, but there is a limit after closeout that you don't have to. The 20% set aside only applies if you receive $250,000 a year or more in program income, because we don't think that a small amount is really feasible to expect people to create an affordable unit. But up until the point of closeout, and after closeout, if it's in significant numbers, it applies.
Thank you.
Chris? And we've got a question from Jennifer. What threshold was used for determining if a warning letter was being issued to grantees relative to concern for meeting NSP 1 and or NSP 3 expenditures?
Jennifer's in the other room right now. I think it's, so this is a little bit different in the sense that, it's a warning letter about, about your expenditures not meeting the requirement, but it's more about it's based on the expenditures, which may have nothing to do, unfortunately, with your drawdown numbers. So it's really hopefully mostly an accounting problem for people. It's also there, and the number I'm using here is 85%. So she's not available, but we've been using 85% as a cutoff for the sort of a place that and that we keep increasing that as we go along. So so basically it's not. I don't think it's something to be worried about, but I do think that you want to have you want to be able to explain this if the question gets asked. I guess so. Hunter, we haven't decided on the percentage yet, but that's kind of where we're going.
So maybe approximately 85% right now.
Right. So if you're, and that's and that would be the 85% is what we're looking at as the drawdown, which is much closer to reality. But like I said, we've got some grantees that have drawn over 100% of the grant amount, and they have zero expenditures recorded. So, so that's not a performance problem. That's a reporting problem. We're concerned about both of them.
So, at the moment, all the questions that have come in. So, John, did you want to?
Yeah, I'll just summarize this. So, for those of you who weren't here at the top of the program, we are offering a closeout webinar next Tuesday, December 4th at 2 o'clock, and also on Thursday we're going to have a webinar on disposition and demolition with implications for land banks, and it's all about, how do you meet a national objective with properties that are not going to have occupants in them for the most part. I mean, that's usually what that boils down to. And I think it's been so we're not going to take questions on this today. We're still working on the webinar, and but I do want to just kind of summarize for those of you who haven't had the time to take a look at the closeout notice. It came out on Tuesday. In the Federal Register, you can get it online. But the context of this is that we are going to have this webinar. We are already starting to develop a grantee guide to closeouts because, as with most Federal Register publications, it's not a especially user-friendly kind of a device. And that'll be ready in sometime in January, at which point we will have another webinar on how to close it out. And then we'll have another one after that to deal with questions and so forth. So now you're not on your own on this one. There's going to be a lot more information. But the bottom line is that nobody, there might be 5 grantees that are actually ready to close out according to our information. In order to close out, you have to have all your money spent. You have to be basically have no left in your line of credit or a negligible amount. You have to have, and this is the important one, have to have met a national objective for every activity. So you have to, show us that the demolition that you did met a national objective through area benefit, or mostly you will be showing us that you have not only rehabbed houses but sold them or rented them and that they're occupied. So that's really the focus of, that'll be your focus after the expenditure deadlines. But the big priority is still to make sure that you can actually spend out 100% of your grant amount by February or March. And you all have somewhat different dates for that in NSP 1 and 3. 50% expenditures for NSP 3 by next March. NSP 3, we publish these drawdown figures every week. If you look at the NSP 3 numbers, you will be horrified to find out how many grantees have spent less than 1% of their grants. If you're in the bind, you don't have a plan, please get a hold of us, and we'll try to get you some technical assistance. So just to summarize the closeout, it's broken into 2 parts. One is fairly straightforward. It's just about what is closeout. When do you qualify to close out? And again, I say, all your costs have been paid, all your activities have been completed, your 25% set aside has been expended, and you have fulfilled all your other responsibilities, primarily including the one to meet national objective for each activity. So if you do that, you would be eligible to close out. Time-wise, there is no deadline for closeouts, so you are not going to be under any gun in the foreseeable future to close out. Probably a couple of years from now, we'll start setting some limits. But right now, it's really driven by your ability to get your units completed and occupied and all your costs taken care of. So after 4 years of deadlines, you're going to miss them, but that'll finally burn off. And there's a section on, how do you actually do the closeouts. I'm not going to go through that, but basically it boils down to, final quarterly progress report. You will celebrate that day, I'm sure. You have annual performance reports to deal with after closeout, but you will no longer have a QPO to deal with. We will have, issues that we resolve, and then, the big thing is that we'll have a closeout agreement, and it'll deal with, what's required to be done going forward. The program sets, how are you going to deal with property that you still hold, how are you going to deal with land bank property, how are you going to ensure continued affordability for all the units that you have occupied. You'll be giving us your plan for doing that. So they're all fairly, I think, fairly understandable, fairly straightforward. you'll have certifications, insurances, and so forth, and then it'll be a kind of an ongoing monitoring responsibility for HUD field officers and probably for a couple of folks here in headquarters as we go forward. So the part of the closeout notice that people I think were most interested in is actually not part of the closeout process so much as technical corrections to previous notices that we needed to clarify, or in some cases try to improve the reading so that it works better out there in the world. And so one of these is demolition. Those of you who are faithful followers will recall that we have said that you've acquired a property to demolish it. You can national objective for the acquisition by improving the neighborhood, a moderate and middle income neighborhood, but then you still have this problem of how to dispose of it. And so what we've tried to do here is to say essentially that the disposition, we've moved acquisition and disposition into use D as eligible activities, and you only have to meet another national objective if you dispose of the property, and chances are you will want to dispose of the property at some point, and we have tried to simplify that by making it the requirement that you meet a national objective with the subsequent use, even if the activity itself is not something that's eligible for NSP. So a simple example is a community garden in NSP 2 or 3. You can't build a community garden in NSP 2 or 3, but you can donate that land or give that land to a neighborhood association, and they can build the garden with their own money or but equity, and the property to the national objective will be happy. You disposed of it, that's the eligible activity, and it meets a national objective, and then you can close that one out. And I think that's been a thorn in everyone's side for a couple of years now. So that I think is going to remove a lot of sort of headaches of how do I actually get rid of some of these properties in environments where there aren't any there isn't any for housing. The same is going to be true for land banks. One good piece of it is that the 10-year period to dispose of a property will begin with your closeout agreement date rather than the date you acquired the property. Chances are you've acquired a lot of different properties on a lot of different dates, and it didn't make sense to try to track all that. So we will just be declaring that the 10-year clock starts when you sign your closeout agreement. But the disposition approach, and we will have a webinar on disposition on Thursday, a week from today. Disposition will follow the same philosophy that if you anything that meets a national objective basically is okay. If you can eligibly create that activity with NSP funds, you can do that. But if you have other sources of funds, as long as it meets a national objective, you'll be able to do it. There's going to be some issues, I think, with how there'll be any number of sort of little side issues on that question. So I'm not going to get into those today, but I think that you just think of disposing property and meeting a national objective, and I think if you look at the list of examples of things that you could do to meet a national objective under land banks, you will see that there's probably going to be a lot easier than you think to do that. So obviously we want to get things happening on those parcels, but it's just not realistic in some places to think that's going to happen in 10 years. So economic development, we're adding 7203 from the CDBG regulations, the economic development activities, as an eligible activity. It will be applicable to NSP1 under use E, only NSP1 under use E, because under NSP 2 and 3, use E has to be for housing, but NSP 1 and 3, you can redevelop foreclosed residential property under use B. So there may be some ways to do some redevelopment. Realistically, if you're in the middle of a residential neighborhood, this is probably not going to add to your list of tricks too much, but it does open up a new opportunity. And these things were eligible under NSP 1. The mixed-use scenario that Chris Plummer mentioned recently would be one of those. We're adding back low, moderate, and middle-income jobs, and some economic development activities can meet an area benefit as well. So, program income, basically, this is, you will need to spend down your program income as far as you can prior to closeout. You can continue to receive it after that, but at some point we're going to have to zero out your bank account. So that'll be a timing issue, and we'll work with you on that. But post closeout, program income will continue to be NSP money for the most part. You can still do new construction. You can still go up to 120% of area median income, but 25% of that money will have to go to a low-income set-aside as before. And so basically, this means that you will have sort of a small component of NSP funds that will eventually dwindle down to nothing, but it could be, I think, a pretty good companion to your CDBG and home programs. I'm going to get into it here, but the rules for nonprofit consortium leaders and non-implement NSP3 grantees are going to be slightly different for program income. There aren't too many of those, so I'm not going to get into that today. On affordability, you will have to develop you will have to report for the affordability period. We will be transitioning over to the IS system eventually, but for the future, you'll still be reporting through DRGR, and that will be part of the closeout processes. How many units are there, and how are you going to assure do some reviews of those on a regular basis to make sure that the requirements are being met. So I know I'll be thrilled to be transitioning into IDIS, but we will be developing a new system there, and it's not hasn't even started yet. So, and then for those of you who wanted to had some hope of getting a little additional funding for your program, the amount of funding that we have recaptured through NSP1 so far from failure to meet obligation requirements has been negligible. I mean, it's $20 million approximately. I mean, I wouldn't mind having that in my bank account, but it's negligible. It's less than 10% of the original $4 billion NSP1 application where it came from. So those funds are going to go back to the disaster fund, which is our default setting for recaptured funds, and actually that's where we started out with the NSP notice back in 2008. So I'm sorry to disappoint those of you who thought you might get extra funding, but realistically, it's just administratively not feasible to administer a smaller amount of money on a whole new timetable and everything else. So that will go to disaster relief, and that's where CDBG funds that are recaptured have historically gone. So that's kind of the highlights of it. I personally feel that people are going to be a little down in the sense that this thing has just dragged on for so long that people might have expected more. I hope you won't be disappointed, but I think that on balance, the number of things that we've made easier and more attractive has far outweighs the number that might seem more difficult or constrained going forward. So, as I said, we're not prepared to answer questions on this yet. Please give us a little more time to prepare for that. But this is, closeouts are not your, we keep saying this, but I want to say it again. There is life after deadlines, and that's where closeouts happen, and there's no deadline for closeouts. So, your highest priority right now is to make sure that you get your grant funds 100% expended if you're NSP 1 and 2, and 50% expended if you're NSP 3 by February, March, when most of your deadlines come due. If you are at all concerned about that, we need to hear from you right away. You can write in through our website. You can call your field office. You can call us here. There is a way to request technical assistance directly through the site. Typically, those requests are for sort of short-term, limited kinds of assistance that we can provide through remote, somebody working with you on your computer and over the phone, and we generally turn those around in about a week. So, we can get you some help pretty quickly, but you need to let us know. Otherwise, we will be focusing over the next couple of months, as Hunter mentioned before. Our webinar schedule is really heavily built around getting the DRR, straight, getting your expenditures straight. We have Paul Webster is going to come on. Is that the one on the 15th?
That's the one on the 15th. Yes.
Yeah. So if you never heard of the name Paul Webster, you need to know he is the man mountain of financial management here at HUD. I just saw on his wall that he had his third year government service award from 2000. So that's 42 years in my way of calculating it. So it doesn't. It's unknowable.
We have gotten a couple more questions came in. Hopefully they're on non-closeout topics. And first up is Tatiana. Is it Martins?
That's right. Hello, how are you?
Doing well, thank you.
Okay, this is the question, and it's related to NSP 3. The amount of units that we were supposed to accomplish in our target area was originally 17. We had on a developer's agreement that was supposed to create 189 units. However, it seems like that deal is going to fall through. The question is this: what happened? What are the consequences of not being able to actually accomplish the full amount of units that are required for that target area?
Well,
because we're going to have the leveraging at this point.
Right. So there's two related questions there. One is the expenditures, and the other is the accomplishments.
Yep.
Meaning occupied units. With the expenditures, there's not a lot of flexibility. We're going to be looking for those to be met. But we do recognize that that projections, particularly in SP1 and 3, and to some extent in SP2, are were just that they were estimates, and so we will look at what you've been able to do, look at why you might have fallen short, and on an individual basis determine if there was good cause for what happened. You should be okay. Obviously, if you fall a little bit short, it's one thing. If you don't do anything, then you got a problem. But if it's a matter of just coming up somewhat short, we'll look at the circumstances and try to work with you and see if there was a good reason for it.
Okay, perfect. Now, the other question: if we at this point, because the market we have seen has changed a little bit since we originally proposed that target area, we just check, and there are only 16 units that are foreclosed on that particular census tract. We're supposed to get, again, 17. If we see that another area within the city is at the tipping point where we can actually get a better amount of units and make a bigger impact, can we just make that change in the action plan and just proceed with the other area?
Right. Yeah. Yes. I mean, you need to do a local amendment, and it has to go to Maria in Miami there at the field office. But yes, and many NSP3 grantees, it's been a couple of years since we first developed that, and the market conditions have shifted for any number of communities. So I personally would recommend, if you're going to, rather just adding and adding and adding, if you're going to move to another area, then tract where you start, the one you started from, because we don't want people to get too thin, spread too thin, so you stay in an area, you need to do 2 units, and then you go someplace else and you need to do 5 units, and ultimately we want you to have an impact, and it's not likely to happen if you're just doing it in like kind of small sprinkles. So but it makes sense, and the market conditions are there. You have the ability to make that amendment.
Okay, perfect. Thank you.
Welcome.
Thanks. Thank you, Tatiana. And another question here from Leslie, who says that previous Q&A provided guidance on moving funds between awards. Agree that once NSP2 funds are expended or down, you can't change your mind. But if front-end work is done, like an action plan or DDR, can funds be moved if not drawn, even if they are allocated?
Not allocated. We've been learning this the hard way lately. So, and you may need to contact us and figure out what you are. But there's an OMB rule against shifting funds around that have already been allocated, and it was really kind of designed for situations in which people are just kind of trying to avoid one set of restrictions. And I don't think that's what you're talking about here. But if there is, on the other hand, Paul has, we talked to Paul Webster about this just recently. Again, Paul is saying, well, look, if you have both of the activities in both of the programs and you have not made a commitment to a particular activity in one year, you could take those and commit to another activity. But it's the, once it's allocated, it's tougher to do that. And I have one where the first time I had this question, the funds had already been spent, and the question was, well, can we kind of back the funds out of this program and put them into that program to, sort of make things work out better? And the answer to that is no, not at all. But if you haven't spent them and you haven't, and you think that's possible that they're not allocated, then you may be able to shift them around. But you really would want to talk to your field staff or somebody to work through the particulars. This is something that I was just really made of a couple of months ago, and it's a question we're getting a lot these days. So I think it's the reality is it's going to pretty much always be determined on a case-by-case basis, because unless you've just got the money sitting there and you haven't done anything with it yet, there's you could allocate it. So you want a decision on that.
And John, what is the definition of allocated? Well,
it's committed or obligated basically, and so that in mind that's under contract. So clearly, if you have like a rehab contract, that would be allocated. I think there's some activities aren't quite as clear. I mean, staffing, and that kind of stuff. So I think that it's, I say, you really ought. I mean, so you can go to the OMB Circular A87 and read the definition of allocated, and they give examples and so forth. But
under allocable costs.
Yeah. So it's an accounting kind of issue, and I'm not an accountant, so I can't give you the absolutely perfect answer. But when I've asked people, I haven't gotten what I consider to be sort of clear cut line.
Will M be circular? Was that, John?
A87.
A87. Okay. Good. Okay. At this point, it does seem that questions have come to a halt. So, again, remember that this webinar was recorded, is being recorded, and will be on the NSP Resource Exchange. That happens very quickly, along with the transcript that will be there soon and the slides. And you did see the coming webinars just a little bit ago, but there's a reminder about them. And those start as early as Tuesday with the closeout webinar. And when you leave, you'll be automatically redirected to a SurveyMonkey form, and we appreciate your taking a couple minutes to fill that out. That's all it requires. And written comments are particularly helpful there. So if you have anything more to say than just indicating numbers, that would be great. And I'd like to thank all the panelists today, John and David and Hunter and Jennifer and Ryan. Big cast of characters for a Q&A webinar. Any final words from any of you?
No, we appreciate everyone's showing up. I think part of it was driven by the closeout, but that's Tuesday. So come back and tear into it on Tuesday. Start thinking about how this affects you, and we'll try to have answers for as many questions as we can. Yeah, just get out there and do your best and call us if you need help. Thanks, everybody.
Thank you, guys, and thanks, everyone, for being here today.